capital structure theory, is it possible to increase shareholder wealth by changing the gearing ratio or the gearing level? Capital, all right, simple box diagram here. It says capital, you got debt, and you have equity. Capital is repayment and security. Debt, investors normally require security. Equity, you can lose everything. Company goes bankrupt. Most companies that go bankrupt don't even have enough money to pay their debt. Now, if they don't even have enough money to pay their debt, what hope do shareholders have? You get the point, right? Yeah. And then it says equity, you can lose everything. Income, interest, dividends. Debt is fixed amount, compulsory nature. Equity is no guarantee payment. Risk levels to provider lower, higher. KD, KE must be higher. This is an example. If you ever do a calculation in a question where KD, cost of debt, is higher than cost of equity, there is only one explanation. You are wrong. Understand? Right? You're wrong. KD cannot be more than KE. KE has to be higher. Are we clear? All right. Yeah, let's be clear about that. Right? So, moving on. Now, look at this simple example. Yeah, it says market value of a company. All right, using perpetuity formula. Now, let's say the market value of a company is the future cash flow, assuming cash flows are constant, divide by the WACC, you get the value of the company. That means the present value of cash flows to infinity. Correct? Now, listen. If cash flows are constant, but if you can reduce the WACC, use your common sense. The lower the WACC, the higher the value of a company, am I right? Cash flow constant, what? Cash flow constant, divide by smaller number, you get bigger answer. Are you with me? Right? So, what is the objective of finance again? Maximizing shareholders' wealth. If by reducing the WACC, you can increase shareholders' wealth, then it's the duty of every finance manager to try to find a WACC that is minimal, because the value of the company will go up. Get it? Yeah? If you read that, if you can reduce the WACC, this results in higher market value, NPV, of the company, therefore increases shareholders' wealth. If it is possible to reduce the WACC by changing gearing ratio, then finance managers have a duty to achieve the optimal gearing level capital structure. Very true. So what mix of debt, KD and KE, give us the lowest WACC? Debt cheaper than equity, KD less than KE. Debt less risky than equity, therefore the return required by investors is lower, translates to a lower cost for the company. And tax relief on interest payments. Company gets tax relief on interest payments but not on dividends. Alright? So therefore you may now think, solve the problem, let's simply issue more debt, we'll get a lower WACC. But more debt also increases the WACC. Why? Alright? Think. When a company borrows a lot of money, company faces something called financial risk. Now I'm going to ask you a common sense question. Who bears the risk? The lender or the shareholder? Think. Let's think about this logically. Your first impression would be to say, oh, if I take a lot of loans, the lender bears the risk. No, the risk actually falls on the shareholder. You see, let's think about it. Again, to repeat my point. Who gets guaranteed payment? Lender, example bank, or shareholder? Bank. Bank contractual agreement. So if I have a lot of loans, all right, even if I cannot repay the loan, the bank will still find a way to get the money back. Bank has first right on the assets, security, etc. Shareholders take more risk. You understand? My point, when there is high levels of financial risk, all financial risk is borne by shareholders. Read that. Debt also increases the WACC because why? Higher gearing, higher financial risk. Higher financial risk, you get higher beta equity. Beta equity, this is the beta factor of a geared company. Geared company that has debt. Then, if beta equity goes up, KEG goes up. KEG, cost of equity geared, KE in a geared company. Now you have to contrast that with KEU, cost of equity ungeared, KE in an ungeared company. Do you follow? Understand that when a company borrows a lot, it is shareholders who bear the financial risk. And if a company borrows a lot, cost of equity is not going to stay constant. Shareholders will demand a higher return because they have to bear the risk from borrowing. Do you understand this point? Right? Yeah. Now, and if cost of equity goes up, then what happens? WACC goes up. All right. So, geared company dividend more volatile, therefore financial risk is higher. Thus, shareholders will demand relatively higher return to compensate higher risk. Cost of equity does not stay at a constant level as financial risk increases. Financial risk exposure will be borne by shareholders, not debt holders. Understand? All right, keep that in mind, yeah? Now, moving on. Theories of gearing ask the basic question, which has the greater effect on the WACC? Reduction in WACC caused by cheaper debt or increase in WACC caused by increase in financial risk and cost of equity geared? Listen, I'm going to go through all these theories one by one, yeah? I'm going to start with the first one, M&M theory. This is the name of the people who came up with the theory, Modigliani and Miller. Right? If I'm not mistaken, last September sitting, right? No, December, sorry. December sitting. We are in December, right? December sitting, right? Capital structure discussion came up. There was a discussion on optimal capital structure, gearing and all that. So although this is a topic, pay attention, although this is a topic that traditionally is not tested, it is something you need to learn. And there lies the problem in your exams. You never know what's going to come up. So when a topic that has never been tested for a very long time, there's a tendency for you to think that, you know what, it's not going to come up. And next thing you know, wham, it'll come out and slap you right across your face. Correct? You'll be sitting in the exam wondering, oh my God, I learned this, but I forgot. You don't want to do that. You know what I mean? That's a horrible feeling. Knowing that you've done it, but you can't remember it. That's horrible, isn't it? That's a really horrible feeling, right? You're like, oh, damn it, I did it, but I can't remember. You don't want to be there. All right? Yeah. So again, M&M, first theory, no tax. I will elaborate. Assumes that the benefit of debt and the increase in K is the same. So I'll show you shortly that there's no optimal capital structure. And then later, M&M revised their theory to introduce tax, right? 1963, I think. And in when they included tax, the argument shifted. The argument was, the more debt you have, the better it is. Wow. All right. Then you have traditional theory, which says the WACC is U-shape. U-shape is parabola. All right. There is optimum gearing ratio. Pecking order argues no theorized process. Basically, pecking order says that all the earlier theories are a waste of time. How do companies raise finance based on which is easy to raise?